Greetings, I'm Andrew Ludwig and welcome to BLACK ONYX Alternative Investments, where we bring you face-to-face with South Africa's most talented boutique asset managers and industry stakeholders. Why do we do this? Because we believe that you, the investor, deserve to be better informed so as to achieve the best risk-adjusted returns. Today I'd like to introduce you to Murray Winckler. He's the co-founder of Laurium Capital, which was established in 2008. Murray, thank you very much for joining us today. Please tell us a little bit about your background and how you got into alternative investments.
Hi Andrew, yes. I started off, accountancy background, and then in the late 80s joined a stockbroking firm, Ivor Jones Roy, as an analyst, and progressed from there. We eventually sold out to Deutsche Bank. I spent 12 years in Deutsche Bank in various roles. And then in 2006, I guess it was, left and took a year and a half off sabbatical. And loved being on the sell side, investment banking, but then decided what I wanted to do. And took a while off and then looked around and was very keen to get onto the buy side. There were quite a lot of opportunities in the long-only space. But the hedge space always intrigued me. It's a lot more, technical and interesting. And it was a big industry globally. There's some $3 trillion of money in hedge funds. All the endowments in the States were invested in it. And in South Africa, it was a small industry, and I thought it would grow pretty strongly going forward.
Tell us about Laurium Capital and how the firm was formed and some of the funds that you represent.
So basically started up the business 2008, 6 weeks before the Lehman crisis, so not very clever. Got Gavin Forberg, who was also at Deutsche Bank for some 10 years, to come back from London. He was on the derivative structuring side and had been an analyst for many years. He came and joined me, and we managed to cobble together a bit of money. And at that stage, it was actually 100 million rand we got, some of our money and some of good mates, and started our first hedge fund, the long-short hedge fund. An average net exposure to markets is around 50%. So that's what we did. And shortly thereafter, we did a market neutral that didn't take any exposure to the market as well, about a year and a half later. And those were the two primarily funds that we ran. The assets steadily grew, probably not as quick as we thought, but they did grow. And then it must have been about 4 or 5 years later that we actually got into an aggressive version. A lot of the clients' markets were doing quite well. Our returns were decent, but they wanted more returns, more VUMA. And we started an aggressive version of our hedge funds. And so that was our foray into the hedge fund space. And what we did do was about 4.5 years ago, we got into the long-only space as well. And we started with a flexible unit trust, which is very much in line with, from our perspective, best suited to our skill set, being able to move our nets around quite a bit. And that's has steadily grown. And then the evolution of that was a couple of years later, we got requests from some institutions to do a fully invested Swiss mandate. So that was a pure equity fund, fully invested. And then another fund that we did do at a later stage is a Reg 28 fund, which is for pension funds.